Hey everybody, my name is Arjun and welcome back to my channel. It's been a minute, hasn't it? In case you missed my update, I had to get shoulder surgery, so I took some time off to recover. But I'm feeling much better now, back to making videos, and what else to talk about but this crazy market that we're in. The Nasdaq is down 23% for the year. Bitcoin is down 36%, real estate is starting to slow down, and there's also fear of an upcoming recession. So let's talk about all of this, what's causing it, and how we can come out ahead at the end of it all. 2022 has not been kind to the stock market. We're seeing negative catalysts everywhere. High inflation, the Fed hiking interest rates, the Russia-Ukraine situation, lockdowns in China causing supply chain issues, and of course, poor earnings reports. Major indexes have been feeling the pain. The S&P 500, Dow, and Nasdaq saw 7 straight weeks of weekly losses before a small rebound this past week. We even flirted with a bear market for a bit when the S&P 500 declined 20% from its high. Tech companies were recruiting like nobody's business in 2021, tempting employees with high salaries and bonuses. However, this recent downturn is starting to change that. Either hiring freezes or layoffs have been announced at Meta, Uber, Robinhood, and Peloton. Other big companies like PayPal, Shopify, and Netflix are all down more than 60% from their peaks. Apart from some energy companies, we're seeing red pretty much across the board. This has scared investors into thinking that a recession is just around the corner because we don't have the Fed to swoop in and save the day this time. To bring inflation back to normal, a stock market sell-off that slows down economic activity is exactly what the Fed wants to see. By the way, a recession is defined as 2 consecutive quarters of declining GDP, of which we have already had the first. Others think that these fears are overblown because strong employment numbers coupled with improved consumer spending are not exactly signs of recessionary times. So it'll be interesting to see which scenario plays out. Real estate is a sector that millennials, quite honestly, wouldn't mind a slowdown. In the past 2 years, low interest rates and limited supply has pushed the median home price in the US from $329,000 all the way up to $429,000 for a 30% increase. Average home price appreciation before this was only 3 to 4% a year. So this has made housing unaffordable in many cities for the average person. If you've tried to buy a house recently, then your experience probably went something like this. You found your dream home, you got all of your documents in order, smartly offered 10% over asking, only to find that 20 other people also bid on the same house, and it sold to a couple bidding 50% over asking, all cash, promising to name their firstborn child after the seller. However, we are seeing signs that this crazy pace is starting to slow down. Mortgage rates have quickly risen past 5% for a 30-year fixed rate. Once borrowing becomes more expensive, so does buying. Let's say that the maximum you want to pay for a home, including taxes and insurance, is $2,700 per month. With the interest rate at 3%, like during the pandemic, you can afford a $500,000 home. When the interest rate goes up to 5%, like we have now, to keep your monthly payments the same, you can only afford a $425,000 home. Make sure to like this video if you've learned something so far. Housing inventory is also slowly starting to get better, especially in hot markets like California and Colorado. Sellers are rushing to take advantage of this hot market. As inventory increases, the supply-demand equation becomes more balanced, resulting in slower house price growth. I don't think we're likely to see a crash like 2008, but a slowing down in demand would not be a surprise. We haven't fully seen this reflected in the numbers just yet, because real estate prices traditionally are a lagging indicator. So we'll likely see the effects of this 3 to 6 months from now. The crypto market has not been safe from the sell-off either. Bitcoin is currently sitting at $30,000 at the time of filming, down 36% for the year. One of the reasons for this collapse was the whole Terra Luna fiasco. This is a bit confusing, so try and stay with me here. Luna is a part of an algorithmic stablecoin pair with an other token called UST. Basically, these two work together to keep the price of one UST pegged to $1. The way it's supposed to work is that you can always exchange one UST for $1 worth of Luna. So if UST dropped to 99 cents, you can buy UST, exchange it for Luna, profit 1 cent per token, and bring the price of UST back to $1. The opposite happens when UST goes above $1. It's speculated that a crypto whale dumped millions of dollars of UST to depeg the stablecoin from $1. The Luna Foundation unsuccessfully tried to deploy Bitcoin from their reserves to try and hold the peg. This caused more panic in the market, resulting in more selling of both the coins. Terra crashed from $119 at the peak all the way down to zero. To put that into context, a top 10 coin was just completely wiped out. The bad actors are estimated to have made $800 million from the attack. This just shook investor confidence and dragged the whole crypto market down along with it. Many investors got into the market during the pandemic crash of 2020. Since then, their portfolios have only been going up. This is really the first time that they're being tested, when things aren't going their way. But worry not, because I have a plan. Taking into account high interest rates, the macroeconomic indicators, turbulent inflation, the best strategy I have come up with is crying myself to sleep. No, but on a serious note, I'm just holding on to my investments and buying more in solid growing companies. My focus is index funds, but I will pick up individual stocks here and there when I see a good deal, many of which are popping up right now. However, I am taking a hard second look at any speculative investments and seeing if it still makes sense to hold on to them. These are the ones that are usually most affected during downturns. It's important to remember that you only ever lose money when you hit that sell button. Paper losses or gains don't really count for anything. So as long as you have the discipline to ride it out, this too shall pass. It always has. When you zoom out, you see that this is just a temporary blip in the market. The long-term trend line has always been upwards. That's not to say that the market won't go down in the near term. The problem with waiting is that no one really knows where the bottom is, and it's pointless to try and time it. Many professionals have tried and failed spectacularly at it. The best thing to do during times like these is to ensure that you have an emergency fund in place, diversify your investments, and keep dollar cost averaging all the way down and back up again. Sometimes it's just reassuring to hear this message during difficult times. Next week, I'll be talking about a clever tax trick I've used to make thousands of dollars during this downturn. So if you want to know what it is, make sure to hit that subscribe button and turn bell notifications on so that you're notified exactly when that video comes out. That's all I have for you today. Thank you so much for watching. I'll see you in the next one. Bye bye.